Preface. A range of factors, including the domestic and regional, i.e. EU legislatures, national and international standard-setting bodies, and private and voluntary sector organizations, supply the legal and non-legal norms, principles, standards, guidelines, and rules that go to make up the framework which is assigned with the task of governing corporate finance and related activities in the whole of UK. The common purpose underlying this vast body of regulatory activity is to establish an optimal package of commands and incentives to stimulate desirable behavior and to curb undesirable behavior by affected parties. Some of the main elements of the regulatory framework are as follows. Legislation. The Companies Act 2006 is the principal piece of primary legislation relating to the formation, operation and control of companies. This Act applies to companies incorporated in Great Britain, England, Wales and Scotland, and also to companies incorporated in the remaining region of the UK, Northern Ireland. The Companies Act 2006 was enacted with the aim of bringing company law more into line with the realities of modern business. Extensive changes made by this legislation were largely based on an independent review of company law which was conducted between 1998 and 2001 by a group of experts brought in by the government. This group of experts, known as the Company Law Steering Group, produced a series of consultation documents and helped to build a broad consensus in favour of reform. Some sections were simply restated versions of provisions that were in the Companies Act 1985 and brought into the 2006 Act because it was deemed preferable, as the government spokesperson put it, to make the new legislation much closer to a complete code of company law for the majority of users. The Companies Act 1985 remains in force only for certain specialised purposes that are outside the scope of this work. This Financial Services and Markets Act 2000 provides, among other things, the regulatory framework for issuing securities to the public and for the admission of securities to trading on a regulated market. Regulatory approval must precede publication. The scheme for establishing an issuer's home state is established by the Prospectus Directive. For a community issuer, its home state for approval of share prospectuses is the state in which it has its registered office. Thus, a UK issuer has to apply to the FCA for prospectus approval. A foreign, non-EEA issuer has a one-off opportunity to choose its EU home state. The rigidity of the approval regime has generated some controversy. Before the Prospectus Directive, issuers were tied to their home state only where an element of their securities issuance or listing activity was taking place there. If the home state was not involved, an issuer could seek regulatory approvals from any one of the states in which that activity was occurring. The reduction of issuer mobility in this respect is based on the assumption that home states are assumed to be in the best position to regulate and supervise local issuers, which means the ones who have their respective offices within local jurisdiction that is controlled by the home state. However, tying issuers in this way means that, in effect, national regulations are shielded from competition by their monopoly with regard to their home issuers. This removes some incentives for national regulators to improve their efficiency and effectiveness. An approved prospectus has community scope, which means that it is valid for public offers or the admission of the securities to trading on a regulated market, irrespective of number of states that are part of EU. The only permissible additional formalities are that the home state must notify host states that the prospectus has been approved in accordance with the Prospectus Directive and send a copy of the prospectus, and host states may require translation of the summary into their official language. The cross-border use of approved prospectuses is considered further in details later. Introduction. It is easy to incorporate a company anywhere in the world, including that of UK. There is an administrative process involving form filling and the disclosure of information, but the requirements are not burdensome. Making the corporate form so readily available is a deliberate policy choice, which is intended to encourage entrepreneurship and enterprise. Old-fashioned notions of incorporation as a privilege or concession granted by the state are thus very far removed from the modern legal reality. Not only can people who operate businesses set themselves up within a company with a minimum of fuss, they can also subdivide the business into a number of different companies within a group so as to enjoy many times of the advantages of the corporate form. This discussion considers the standard features of the company that help to explain why, either in single entity form or as multiple entities linked within a corporate group, it is the organizational form chosen by most businesses that want to raise large amounts of capital. The advantages of the corporate form as a mechanism for shielding those who run or own a business from personal financial exposure are outlined. The shielding effect of the corporate form supports business innovation because it provides room for the kind of risk-taking that is often needed to get new ventures off the ground. At the same time, however, the fact that the operators of a business in corporate form do not shoulder all of the financial exposure is potentially problematic because it means that they may be tempted into excessive risk-taking, which, if it is unsuccessful and the business fails, will result in creditors of the company being left with worthless claims. In its ability to allow the operators of a business to benefit fully from its success, but not to absorb the full costs of its failure, the corporate form thus contains a deeply embedded moral hazard problem. The policy challenge, therefore, is to strike a sensible balance between encouraging entrepreneurial risk-taking and preventing reckless or abusive conduct. How lawmakers in the UK have responded to the challenge and how the choices they have made compare with those made in certain other developed economies are also issues considered in this chapter. These issues go to the heart of what company law is really about, as debate in Europe has recognized if company law's primary goal is to be facilitative and helpful to those who establish and operate businesses. The policy choices on striking the balance between competing concerns may be quite different from those that would be made from the starting point that company law's essential role is to protect people who deal with businesses whose operators benefit from the shielding effect of the corporate form. Distinctive features of the company limited by shares. An incorporated company limited by shares has two distinctive features that are of particular significance in relation to corporate finance: separate legal personality and limited liability. Separate legal personality. An incorporated company is a legal person separate and distinct from the people who hold shares in it and the people who manage it. This has been a foundation stone of company law in the UK ever since the decision of the Judicial House of Lords in Salomon v Salomon and Company Limited. Mr. Salomon was a boot and shoe manufacturer who had been in business for over 30 years as a sole trader. He then converted his business into the newly fashionable company limited by shares, incorporated under the company's legislation of the time. Mr. Salomon financed the company partly by investing in its shares and partly by lending to it and taking security. The incorporated business failed and the company became insolvent. An action brought by the company's liquidator gave the House of Lords the opportunity to consider fully for the first time the consequences of incorporation. It held that an incorporated company was a legally different person from the persons who had formed the company. Accordingly, even though Mr. Salomon controlled all the shares in the company, it was legally distinct from him, and he could not be made personally liable to make good the shortfall in the company's assets. Various consequences follow from the fact that a company has a separate legal personality. A company continues in existence even though managers and shareholders may come and go. It is the company, not its managers or shareholders, that acquires the contractual rights and undertakes the contractual liabilities that are involved in the running of the business. A contract between a company and a substantial shareholder, even one who controls all of the shares in the company, is a valid bilateral contract. A company can have as one of its employees the controller of all its shares. As a legal person, a company can incur tortious liability and can be prosecuted for committing crimes. The property of the business is owned by the company, and its shareholders do not have an insurable interest in it. If shareholders misappropriate the company's property, they may be guilty of theft. The designation of a pool of assets that belongs to the business rather than to its operators personally, which is achieved through incorporation, has been described as affirmative asset partitioning. Affirmative asset partitioning shields the assets of the business from the people behind it, and importantly, from the personal creditors of those people. Affirmative asset partitioning is a feature that makes the corporate form attractive as a vehicle for raising finance. Financiers can concentrate their risk assessment processes and investigate and monitoring efforts on the particular entity to which they are supplying capital, thereby avoiding costs that would otherwise be passed through to the operators of the business that is seeking external finance. Chapter 1. Veil of incorporation pierced. Piercing or lifting the veil of incorporation means looking through the corporate form of its shareholders. It involves disregarding the separate personality of the company. The vital commercial significance of incorporation is respected by the law, and it is therefore exceptional for the veil to be pierced. In Barclay Pharmaceuticals Limited versus Wayfarm LP, Gloucester J expressed the orthodox position when she noted that the corporate form is a structure that facilitates the raising of necessary capital for business, and that for this reason, only in exceptional circumstances does the law allow the creditor of a company to pierce the veil of incorporation. The VTB Capital versus Nutritech International, the Supreme Court even considered the argument that there is no jurisdiction at all for a court to lift the veil except where a statute provides, but determined that it was unnecessary and inappropriate to resolve that issue because the case for piercing the veil could not succeed on the facts. In the VTB decision, Lord Neuberger P. acknowledged that the precise nature, basis, and meaning of the principle of veil piercing are all somewhat obscure, as are the precise nature of circumstances in which the principle can apply. This point has also been made by commentators. The position in the UK on this point is not dissimilar to that in other countries. Veil piercing has been described as rare, unprincipled, and arbitrary by one US commentator who has suggested that it should be abolished altogether. Another has described it as a mangled and muzzy doctrine that would benefit from principled simplification. One matter that is clear so far as the UK is concerned is that the courts do not have a discretionary power to lift the veil in the interests of justice. Judicial veil piercing is a fallback principle with limited application, which has been developed pragmatically for the purpose of providing a practical solution in particular factual circumstances where all other more conventional remedies have proved to be of no assistance. Recent authorities have described the circumstances in which judicial veil piercing is possible in very narrow terms, as being triggered by the misuse of the company structure by its controllers in order to immunize themselves from liability for wrongdoing outside the company. The following principles have been outlined. First, controlling and owning a company is not enough in order to pierce the veil. Second, this piercing cannot even be done by the court, even when no unconnected third party is involved, merely because it is perceived that to do so is necessary in the interests of justice. Third, the corporate veil can only be pierced when there is some impropriety. Fourth, the company's involvement in an impropriety will not be enough to pierce the veil. The impropriety must be linked to use of the company structure to avoid or conceal liability. Fifth, if the court is to pierce the veil, it is necessary to show both control of the company by the wrongdoer and impropriety in the sense of a misuse of the company as a device or facade to conceal wrongdoing. Sixth, a company can be a facade for such purposes even though not incorporated with deceptive intent. Veil piercing is a mechanism that may allow a court to grant discretionary equitable relief, but it does not extend to enabling a claimant to pursue a contractual claim against a person other than the original contracting party. Whilst the courts may, as a last resort, pierce the veil in circumstances where a company is used to evade an existing obligation that was incurred by a shareholder personally, they are not receptive to piercing the veil where the corporate form is adopted in order to limit the exposure of its shareholders for the debts of the business. The freedom to use incorporation as a means of reducing future legal liability is an inherent part of company law. The implications of the very narrow confines of judicial veil piercing are examined further later in this chapter in the context of piercing the veil of incorporation between companies that are in the same corporate group. Limited liability. Shareholders in a company limited by shares are liable to contribute only a limited amount to its assets. The minimum amount of the contribution in respect of each share is its par value, i.e. its fixed nominal value, because that constitutes the minimum allotment price. Where a share is allotted at a price higher than its par value, described as an issue at a premium, then the required contribution is par value plus the premium. Company law does not set mandatory par values for shares, nor does it require companies to issue their shares at specific premiums. These are matters for companies to decide on an individual basis. Many private companies start life with a nominal share capital of £100 divided into £101 shares. The par value of shares in public companies is often much less than £1 because this can enhance liquidity. The argument being that, for example, 10 shares of 10p each will be easier to sell than 1 share of £1. The mandatory rule that shares cannot be allotted by the company at less than par provides another explanation for low par values. When a company is planning to raise capital by offering its shares for investment, it will have in mind the price at which it intends to offer the shares, but must take into account that the offer price may have to be adjusted downwards in response to market conditions at the time when the offer is made. To enable this fine-tuning to take place, the par value of shares must be practically irrelevant, which means that there must be a large margin between the intended premium at which the shares are to be offered and their par value. Limited liability does not follow automatically from the principle of separate legal personality. Corporate personality means that the company, not its shareholders, is the person responsible for the debts of the business. The extent to which the company can require its shareholders to provide the finance to meet the liabilities of the business is a logically distinct issue. The legislation of 1844 that first established the procedure for incorporating a company by an administrative registration process did not provide for limited liability of the shareholders. Limited liability did not become part of the law relating to companies incorporated by registration until over 10 years later, when the Limited Liability Act 1855 was passed. Initially, not all industries enthusiastically embraced the opportunity to limit liability. Reluctance among banks was especially noticeable. For some time, unlimited shareholder liability was regarded in the banking sector as a badge of prudence, but this attitude did not survive the collapse of the City of Glasgow Bank in 1878, which was ruinous for most of the bank's shareholders. People who lend to companies also have limited exposure. They too are liable to contribute no more than the principal amount that they agree to lend. The basic distinction between the shareholder and the lender is that, whilst both contribute a fixed amount, only the shareholder hopes for open-ended capital gain in respect of the investment. This distinction can easily become blurred. Preference shares can resemble debt finance by offering the investor only a limited capital return. Lenders may make their profit on a loan by advancing less than the agreed principal on the basis that the full amount of the principal is to be repaid, and debt instruments may be structured so as to convert to equity at the option of the holder or issuer, or automatically on insolvency or other specified trigger events. But it suffices as a point of departure for the present discussion. Provided the company remains solvent, lenders get back what they lend, but no more. It is the shareholders of a solvent company who are entitled to claim the residue remaining after all liabilities and claims have been met. Hence, shareholders can be described as the residual claimants. The flip side of the contrast between a lender and a shareholder is the position in an insolvent company. There, in simple terms, the order of repayment is: first, creditors who have taken security on the company's property; secondly, unsecured creditors; and finally, shareholders. Shareholders, at the bottom of the pile, have the least chance of recovering their investment, but because they benefit from limited liability, they do not have to make good any shortfall in the company's assets. The risk of corporate insolvency is thus borne in part by a company's creditors. This has led to the view that limited liability can be regarded as a device for shifting risk from shareholders to creditors. For shareholders, limited liability operates as a shield against having to contribute over and above the fixed amount of the investment they agree to make in return for their shares. This aspect of the shielding effect of limited liability leads to a number of positive consequences which, for convenience, can be considered under the following headings, although they are in fact interrelated: promotion of entrepreneurial activity, passive investment, portfolio diversification, cost of capital, transferability of shares, and insulation from tort liabilities. Chapter 2. Promotion of entrepreneurial activity. Limited liability encourages entrepreneurial activity because it allows people to limit the risks involved in conducting business. This is the main function of limited liability in quasi-partnership type companies, where raising share capital from persons other than the controllers of the business or their families is usually not a realistic option. The importance of this aspect of limited liability should not be overstated because in a real-life situation it is likely to be whittled away by unlimited personal guarantees, which some providers of debt finance to the business may demand from its controllers, who are likely to be both shareholders and directors simultaneously. To the extent that the personal guarantees are given, contractual stipulation in effect overrides the limited liability position established by company law. Yet not all creditors of the business will be in a position to demand personal guarantees. Some will lack the necessary bargaining strength, whilst others may have no opportunity to bargain because they are the victims of a tort committed by the company. The controllers can thus still derive some benefit from limited liability. Passive investment. Limited liability facilitates passive investment, i.e. investment on the basis that the investor will not play a part in management. The fact that there is a cap on the amount at risk is an encouragement to investors to allow other people to run a business using their money. Without such a cap, a prudent investor might be disinclined to invest in shares at all, or at least would undoubtedly expect a very high return to compensate for the risks involved. The investor might also want to monitor more closely the way in which the managers of the business conduct its affairs, and that would lead to additional costs. There is a risk that, because they enjoy limited liability, shareholders may allow the managers of their company to take greater risks in the running of the business than they would have permitted if they had to face the prospect of being personally liable without limit for the failure of that business. In the event of such failure, it is the creditors who will have to absorb the loss over and above the amount of share capital that has been invested. Here we begin to see a problem with limited liability, sometimes described as a moral hazard. It is the shareholders who reap the benefit from success because they get capital gains, but they do not bear all the risk of failure. The moral hazard aspects of limited liability are considered further in this chapter in the context of groups of companies because they can arise in an especially strong form in that context. Here the emphasis is on the upside. Successful risk-taking, which may be funded by passive investment, is a positive outcome facilitated by limited liability. As well as benefiting shareholders and ensuring that debts to creditors can be paid when due, successful risk-taking, funded by passive investment, may also produce new jobs for employees and contribute to general economic prosperity. Thus, there is a public interest in the facilitation of passive investment through the provision of limited liability. Passive investment means that companies can expand their capital base whilst retaining a cohesive managerial structure involving relatively few individuals who, between them, own only a small portion of the company's issued share capital. In other words, ownership, through shareholding, and control, through managing the business, are able to separate. It was exactly because large businesses, such as railway companies, needed to expand their capital base in this way that there was such pressure for the enactment of limited liability for the shareholders of registered companies in the middle of the 19th century. When limited liability became available, it immediately prompted a spate of new incorporations. The limited liability company rapidly became the means whereby businesses could raise large amounts of finance from a large pool of investors. Portfolio diversification. Limited liability also facilitates portfolio diversification. This is the process whereby an investor can reduce the risks involved in investing in volatile securities by constructing a portfolio of investments in which those securities are balanced by others that are lower risk and which offer a low return. Portfolio diversification does not eliminate systematic risk, i.e. the risk of variability in returns on investments because of the way that capital markets in general respond to macroeconomic developments, such as changes in the tax regime or exchange rate and interest rate swings. Portfolio diversification is all about reducing the specific risks arising from factors which are unique to the individual companies whose shares are included in the portfolio. Without limited liability, portfolio diversification could not eliminate or reduce the risks associated with investing in specific companies. It would have the opposite effect of increasing risk because every time an investor added a new share to his portfolio, that would create exposure to the risk of being personally liable for all of that company's debts. Without portfolio diversification, and in the absence of some alternative way of dealing with risk, such as the purchase of insurance, companies seeking to raise share capital from investors would have to offer them a return that compensated them for taking on specific risk as well as systematic risk, with the result that share capital would become a more expensive form of finance. Some investors might be prompted to withdraw altogether from holding shares, which could cause the costs associated with raising capital by issuing shares to increase still further because of the diminution in the size of the pool of finance available in that form. Other investors might concentrate their investment on one or two companies and engage in closer monitoring and control of the management of those companies, which could generate inefficiencies. Chapter 3. Cost of capital. The return required by the providers of a company's share capital and debt constitutes its cost of capital. Minimizing the cost of capital is a crucial part of running a business, and corporate finance decisions such as how much debt or share capital to have in the balance sheet or how much profit to pay out by way of dividend are all fundamentally about cost of capital. It might be argued that limited liability should not affect cost of capital because all it does is to cause part of the risk of insolvency to fall on creditors rather than shareholders. Thus, to the extent that shareholders can limit their risk, the creditor's risk is increased, and that will be reflected in the interest rates charged in respect of debt finance. This argument is superficially appealing, but it begins to break down on close examination. First, if shareholders did not have limited liability and were personally liable for all of the company's debts, that would still not eliminate the risk to creditors because their chances of being repaid would depend on the creditworthiness of all of the shareholders. Checking the creditworthiness of a large number of persons would be time-consuming and costly, as would enforcing claims against a large number of shareholders in the event of default. Limited liability reduces the costs that creditors have to incur in transacting with companies because they need to check only the creditworthiness of the company itself, and in the event of default, need to sue the company only. In theory, the reduction in transaction costs that follows from limited liability should impact positively on the rates at which the company can borrow. Secondly, a bank or other professional lender that is considering lending a large amount of money to a company can be expected to investigate the company closely. Specific investigation, in combination with the lender's accumulated general knowledge and experience of lending to companies, should put it in a strong position to assess the risks involved, with the consequence that a professional lender may price more accurately the risk for which it requires compensation than potential equity investors would have done had the company sought additional finance in that form. Another possible reason why the savings in cost of capital that flow from limited liability may not necessarily be cancelled out by higher interest rates charged by creditors to compensate them for bearing part of the risk of insolvency is that interest rates are not the only risk management tool available to creditors. Depending on respective bargaining positions, creditors may be able to reduce their risk by taking security or imposing contractual restrictions on the operation of the business. However, some caution is appropriate here. If one creditor accepts a lower rate of interest in return for security, another unsecured creditor may charge a higher rate to compensate it for the risk that, in insolvency, it will rank behind the secured creditor and will have to absorb loss remaining after the shareholders' funds, the equity cushion, have been wiped out. Whether alternative risk management mechanisms that are available to creditors reduce the total amount of interest charged to a borrowing company is thus a debatable point, which is considered further in next chapter. Also considered in next chapter is the deductibility of interest charges, which is a further incentive for companies to opt for debt financing in order to minimize their cost of capital. Transferability of shares. Unless the articles of association of a particular company restrict dealings, shares in limited companies are freely transferable. Shares which are admitted to CREST, the UK's mechanism for the electronic trading of securities, are bought and sold without a document of transfer. Otherwise, shares are transferred by means of an instrument of transfer in accordance with the formalities prescribed in the Stock Transfer Act 1963, where the shares have been paid for in full, or the company's articles, where they are not fully paid. If shareholders had joint and several person liability for all of their company's debts, a relevant consideration for a person investing in shares would be the ability of other shareholders to pay the company's debts. Prudent shareholders would engage in costly monitoring of each other's wealth, and they would want to restrict the transfer of shares so as to ensure that any new shareholders were at least as wealthy as the persons whose shares they acquired. Moreover, share prices would not be uniform. The wealth of the person acquiring the shares would affect the price because a wealthy investor could expect to pay less for the same shares than an impecunious one on the basis that he or she would be taking on more of the risk in the event of corporate default. With limited liability, shares are fungible securities and trading can take place on an anonymous basis. Tort liabilities. Another function of limited liability is that it insulates shareholders from tort liabilities that may be incurred by their company. If, say, a company pollutes a river or one of its factories blows up, then the persons who are injured or who suffer physical damage to their property can seek compensation from the company. Depending on the seriousness of the accident and the number of victims involved, the compensation costs may be very large. Limited liability means that the shareholders do not have to meet the claims from their personal resources. The victims of the tort will be unsecured creditors in the company's insolvency. They may also have a claim against the company's directors or senior managers as joint tortfeasors, but for this to succeed, they will need to establish a distinct personal liability in tort attaching to those individuals. The present practice of the courts in the UK is not to view tort claimants or other categories of non-adjusting creditors more favourably than contractual creditors in relation to piercing the veil. However, whether the law should be more willing to favour tort claimants is an issue that is much debated in the literature. Some commentators consider that the veil of incorporation should not be allowed to shield those involved in a company from the consequences of its hazardous activities. It is argued that preserving the veil of incorporation in this situation may encourage excessive risk-taking by companies and operate unfairly in relation to the victims of the tort, who, unlike contractual creditors of the company, do not have an opportunity to adjust and protect their position through a bargaining process. The debate on this topic is particularly concerned with a situation where the tortfeasor is a subsidiary within a corporate group. The corporate group is a structure that exploits the advantages of the corporate form, separate personality and limited liability, to the fullest extent. It is also the structure that often provides the starkest manifestation of the disadvantages of the corporate form for those who come into contact with it. Accordingly, before moving on to consider those disadvantages, it is appropriate now to look more closely at corporate groups as an organizational arrangement for the conduct of business activity. Chapter 4. The Corporate Group. Complex corporate groups, sometimes comprising thousands of subsidiaries, have become a dominant force in the world economy. The structure of the international financial sector provides a good example of the modern reality. One recent study found that among the international financial conglomerates identified by regulators as large, complex financial institutions, each had several hundred majority-owned subsidiaries and 8 had more than 1,000 subsidiaries. Key drivers of corporate group organizational structures include asset shielding, tax planning, risk management. A group structure may provide protection against the risks involved in operating in politically unstable countries and serve to limit the jurisdiction of the courts of a particular country to certain entities within the group. Administrative efficiency and regulatory requirements. The banking industry can again be referred to in order to illustrate regulation as a driver of organizational structure. The UK's new retail banking ring fence rests on the foundation of a requirement for retail banking operations to be conducted by a separate entity within a wider group. Sometimes the complexity of a group structure may be attributable more to the legacy effects of past acquisition policies than to begin the positive outcome of deliberate organizational choice, i.e., companies may be brought into a corporate group by acquisition and then simply allowed by their new owner to retain their original corporate form as subsidiaries within the group. Analysis of business structures suggests that enterprises which are divided into separate divisions, operating as separate profit centers with responsibility for their own administration, may be preferable to enterprises that have one central management because the divisional structure reduces the length of chains of command and facilitates the setting of goals and consequential monitoring. However, although the legal rules concerning groups of companies would seem to fit well with the achievement of a multi-divisional management structure, evidence suggests that the divisionalization that occurs in practice within large organizations may be unrelated to the formal corporate structure of the group. The recognition of corporate groups in a company law. There is no separate branch of company law in the UK that deals with corporate groups generally, but for particular purposes, the Companies Act 2006 does recognise and attach legal significance to 2 main types of corporate group, namely the holding or parent company and its subsidiary companies, and the parent undertaking and its subsidiary undertakings. The latter type of group is relevant for the purposes of consolidated group accounts. The former is relevant in other specific statutory contexts. The definition of the corporate group for accounting purposes. The purpose of group accounts is to give the shareholders and creditors of the holding company a clearer picture of the use of their investment that could be gleaned from its individual accounts. The process of drawing up group accounts involves treating the assets and liabilities of all of the companies in the group as if they were part of the assets and liabilities of the company that heads the group. This results in the financial statements of a group being presented as those of a single economic entity. The production of annual consolidated group accounts is mandatory for parent companies that are incorporated in the UK, save for those that are subject to the lighter disclosure regime for small companies and certain other limited exceptions. The informational value of consolidated accounts depends crucially on the rules defining the entities to be included in the consolidation, scope rules. The narrower the scope, the more room there is for reporting entities to establish off-balance sheet special purpose vehicles, SPVs, in which they have significant economic stakes and whose activities could have significant adverse ramifications for them. The notorious story of the Enron Corporation, which grew spectacularly during the 1900s and collapsed equally spectacularly in 2001 after announcing a $1 billion plus adjustment to its published accounts, shows what can happen when scope rules are restrictive. The Enron Group made significant use of special purpose entities to engage in off-balance sheet activities. These special purpose entities were not part of the Enron corporate group for accounting purposes, which made it possible to conceal debt and to manipulate financial results. Consolidation requirements were revised in order to take account of lessons from the Enron experience, but public authorities and standard setters always face an uphill task in trying to keep pace with markets that are populated by actors who have considerable incentives to find loopholes in order to minimize regulatory burdens. In spite of Enron-related improvements, the off-balance sheet industry continued to flourish until everything came crashing down again in the financial crisis of 2007 to 2009. The years leading up to the financial crisis had witnessed the rapid growth of structures that employed highly leveraged off-balance sheet vehicles and the use of transactions that took transactions temporarily off balance sheets, both of which had the effect of materially underreporting the true extent of the economic risks that had been undertaken by many institutions. Addressing the use of off-balance sheet special investment vehicles, SIVs, one influential report on the financial crisis noted that, at the individual bank level, the classification of these as off-balance sheet proved inaccurate as a reflection of the true economic risk, with liquidity provision commitments and reputational concerns requiring many banks to take the assets back on balance sheet as the crisis grew, driving a significant one-off increase in measured leverage. But even if this had not been the case, the contribution of SIVs and conduits to total system leverage would still have increased total system vulnerability. It is no surprise, therefore, that there has been another round of reform of the consolidation requirements as part of the regulatory response to the financial crisis. This has involved a move away from bright-line rules to more open-textured standards, but only time will tell whether the new requirements will fare better than their predecessors in ensuring that all material economic risks are properly represented in financial statements and that opportunities for creative structuring are appropriately contained. The UK position on the scope of consolidation requirements is now found in the Companies Act 2006, which gives domestic effect to EU requirements, and in accounting standards. The Companies Act 2006, sections 404 to 5, provide that where a parent company prepares Companies Act group accounts, all the subsidiary undertakings of the company must be included in the consolidation, subject to limited exceptions. In this context, undertaking means a body corporate, partnership, or unincorporated association carrying on a trade or business with or without a view to profit. An entity is a subsidiary undertaking, SU, of another entity, the parent or P, where 1. P holds a majority of the voting rights in SU, 2. P is a member of SU and has all the right of removal or appointments of own board of directors, or 3. P is a member of SU and controls alone, pursuant to an agreement with other shareholders, a majority of the voting rights in SU. P is treated as a member of an undertaking if any of its SUs is a member of that undertaking, and it is also traded as a member of an undertaking in which shares are held by a person acting on its behalf or on behalf of any of its SUs. References to voting rights in a company are to rights conferred on shareholders in respect of their shares, or in the case of a company not having a share capital, on members, to vote at general meetings of the company. In addition, there exists a parent and subsidiary undertaking relationship giving rise to an accounting consolidation obligation where 1. P has the right to exercise a dominant influence over SU by virtue of provisions contained in SU's articles or by virtue of a control contract, legal control. Or 2. P has the power to exercise or actually exercises dominant influence over SU, or P and SU are managed on a unified basis, factual control. These tests recognize that a company can effectively control other entities even without majority voting control. For example, if the majority of the shareholders are diversified passive investors, each holding a small proportion of its shares, one shareholder with a more substantial shareholding may in practice, as a consequence of the voting apathy of other shareholders, be in a position to control the outcome of shareholder meetings, notwithstanding that it does not formally control the majority of the votes. Conclusion. The test based on factual control is more significant in practice because the criteria for legal control are quite formal and rigid. Where the operators of a business want to avoid a consolidation obligation, they are unlikely to regard the legal control limb of the statutory scope rules as being a major impediment to the achievement of this goal. The factual control test is less easy to circumvent. Actual exercise of a dominant influence implies the exercise of an influence that achieves the result that the operating and financial policies of the undertaking influenced are set in accordance with the wishes of the holder of the influence and for its benefit, whether or not those wishes are explicit. The power to exercise dominant influence is a power that, if exercised, would give rise to the actual exercise of dominant influence. The actual exercise of a dominant influence should be identified by looking at the effect in practice. A power of veto may amount to exercise of a dominant influence in an appropriate case. The actual exercise of dominant influence may be interventionist or non-interventionist. Intervention, that occurs only rarely on critical matters, could amount to the exercise of a dominant influence. Entities would be managed on a unified basis, where the whole of the operations of the undertakings are integrated and they are managed as a single unit. Where an EU company has its securities admitted to trading on a regulated market in the EU, it is obliged to draw up its consolidated accounts in accordance with International Financial Reporting Standards, IFRS, or International Accounting Standards, IAS, rather than under its national accounting system. The relevant definitions of entities to be included in the consolidation are set out in IFRS 10. Consolidated financial statements, supplemented by effect analysis, which identifies typically scenarios and provides guidance on the application of the applicable requirements. Under IFRS 10, a parent entity is defined as an entity that controls one or more other entities. Control exists when the investor is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. The effect analysis considers the assessment of control by reference to a series of examples in which no single investor holds more than 50% of the voting rights of an investee.